The Federal Reserve today approved its 10th straight interest rate hike. Now, it was an increase of 0.25%, though markets are more focused rather on where the Fed will be going from here onwards. And here's what Fed Chair Jerome Powell said earlier today.
Looking ahead, we'll take a data-dependent approach in determining the extent to which additional policy firming may be appropriate. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions.
So here to talk to me about the rate increase is Sam Burns, Chief Strategist, Mill Street Research. So all eyes were on Powell and his speech earlier today. To you, did Powell hint that the Fed will be pausing?
Yeah, I think the statement that they put out, dropping the earlier references to potentially further tightening, was really the key clue there that they're probably done tightening for now, and they want to be able to make choices based on the data going forward and not be pre-committed to any further rate hikes. So I think he acknowledged that and seems to be comfortable with the idea of pricing in a pause. I think what he wanted to push back on was the pricing in of rate cuts later this year.
How strong was that hint to you?
I think the hint was pretty strong. I think they seem to be comfortable with the idea that they've gone far enough for now. He did also make a comment saying that by some measures, the current policy rate of 5 to 5.25% is quite tight relative to expected inflation based on some measures, rather than trailing past inflation, and that they're already as tight as they typically would be at the peak of a cycle. He also mentioned that in the March dot plot, the statement of economic projections, that the Fed had already targeted this level of rates as being the potential peak in rates. So in some ways, they sort of met the goal that they had already set out for themselves, and therefore pausing here would make sense.
Now, let me just question you a little bit further on that pause that we're talking about here. Powell did say a decision is not made yet on whether they're going to pause. How are you taking that?
I think that's typically what they say at each meeting. They rarely want to fully pre-commit themselves to an action in the next meeting. But he did say several times that they were going to be data dependent, that they could still hike rates. I think he wanted to leave the door as open as possible for all options. But I think they're a little more concerned now about what's going on in the banking system and lending conditions, and they really want to see how that develops before they make any strong views about what they're going to do next. But I think that's probably what's preventing them from going to be preventing them from hiking rates next time.
And how has the market reacted? What's the market interpreting?
Well, for most of the press conference and everything else, the market was pretty stable. Bond yields are lower today. They were already somewhat lower even before the meeting. So there's no big surprises for interest rates. Stocks had been up a little bit before the meeting and are now down. I think some stock investors might have been hoping for a little more indication of rate cuts to come, or other indications that the Fed was thinking about next steps. But I think overall it was a relatively in line kind of meeting. No big surprises. Most people were expecting this kind of result, and so I don't think the markets have made a dramatic move relative to what they've done in the past.
Did the market like the fact that Powell hinted that there might be a pause?
I think they like that part. Yeah, I think they're a little more worried about what the next implications will be for the banking system, and whether there are some negative surprises coming in that regard. I think that's probably the worry at this point, or that some of the data that will be coming out soon will show continued strength, and particularly in the labor market, and that will then require a little more hawkish commentary.
So the dot plot may be saying that 5 to 5.25% interest rate might be sufficiently restrictive. But from where you're standing, from your perspective, do you think it is sufficient?
I do, yes. I think the Fed has probably already done enough to restrain inflation. I think a lot of the factors driving inflation were kind of outside of the Fed's control in a lot of ways. But I do think that the kind of the point that Powell made is one I've made as well, is that relative to what markets are pricing in for expected future inflation over the next year or two, rates are already quite high. That the market is pricing in about 2.5 to 3% inflation over the next year or two, and that's about where the Fed wants it. And so I think 5 to 5.25% is pretty tight relative to what the U.S. economy is likely to require or need to bring inflation down. I think there's already a lot of indications that inflation is falling. It's just going to take a little while to fully show up in the data.
Speaking about the economy, has it really seen the complete effects of the rate hikes yet, do you think?
Not entirely, no. I think some areas like housing have seen the effects, but I think the rest of the economy is still sort of catching up to that to some degree. And certainly the effects on the banking system are still being felt, the effect on bank balance sheets. But I think that these things do take time. A lot of debt, the interest rates that people pay don't move immediately when the Fed moves rates. They take, it can take a year or two to fully price in all the changes they've made. So I think that they will have a cumulative impact that will continue for the rest of the year and continue to sort of slowly push inflation down. I think housing and a lot of goods prices are already starting to stabilize or fall, and I think the services side will come next.
And speaking of those, could you speak to as well from the consumer perspective, how do these interest rate hikes impact them directly?
Well, certainly the first impact is going to be on housing and the price of mortgages, and then second on autos, the cost of getting auto loans. Those are the two biggest things that consumers typically finance and are having to pay higher interest rates for now. After that, it's really the knock-on effects from, for instance, higher credit card interest rates, which have gone up significantly, and other things that will tend to cause people to have to pay more for financing their spending and therefore cut back on what they're buying. I think the fact that the labor market is still fairly firm offsets that to some degree, but I think that the net effect will be just to slow the pace of consumer spending over, say, the next 6 to 12 months from where we are right now.
And as well, the Fed is projecting higher unemployment this year. Maybe you can also talk about that. How do interest rate increases lead to unemployment?
Yeah, and there it's a little less direct typically, but generally speaking, if companies are having to pay more to borrow money and are potentially going to do less expansion, if they were going to hire people, build new factories, that kind of thing, if the cost of capital is now higher, they might decide to scale back their expansion plans and not hire as many people as they had previously. So to the extent that the demand for labor will slow down because of the higher cost of capital, then that would potentially reduce the demand for labor and bring wages down, and therefore cause inflation to come down in that sort of indirect way. But I think the labor market has been fairly firm because the labor supply has been constrained by a combination of COVID and limited immigration and other factors that have kept the supply of labor relatively muted, while other elements of the supply chain have in fact improved and gotten back to normal now.
So, of course, the Fed's goal is to tighten credit within the economy. And we just had the GDP numbers a couple days ago. Do you think the Fed's previous rate hikes up to that point, how much of it has actually factored into that GDP number?
I think you can see some of it in the housing and investment data that was relatively soft. Those are the areas that are more interest sensitive and that are going to be more directly affected by interest rate increases. The consumer spending side of the report was relatively strong, which is a reflection of the strong labor market and the fact that wages are still growing to some degree. So I think you could see the split between the labor and consumer side versus the sort of business side and investment side, where things have already started to slow down. And that's the area that's most sensitive to interest rate increases, and that's what we're already seeing within that GDP report.
Do you see the Fed in any situation would raise interest rates again? I know it hinted at a pause today, but is that still on the table, a rate hike?
Certainly they want to keep it on the table, at least in people's minds. I suppose if we got sufficiently strong inflation and job data over the next month or two before their next meeting, that they could use that to justify another rate hike. My guess is that it'll probably be a high bar to raise rates again. That if the data comes in more or less in line with expectations, or certainly any softer, that would give them an excuse to pause and to just keep rates where they are. I think their main messaging now is to keep rates where they are, but for longer than the market expects, rather than to go higher than the market expects right now.
Yeah, I mean, the expectation is that the Fed will cut rates later this year. I mean, is that likely from your perspective?
My guess is that by the end of the year, the reported inflation rate will be coming down, and that the 5% interest rates on policy rates will look relatively high at that point, particularly if real GDP growth and real activity has slowed any further. So I think there is a possibility of a rate cut. It would certainly be if it looks like the banks were going to get into more trouble than what we've seen so far. I don't use that as my base case, but I think that the pricing in of rate cuts will come around either by the end of the year or potentially first quarter of next year.
And just one final thing. Do you think it's possible for the Fed to cure inflation without raising unemployment? Do you think that's possible?
It's interesting. I think the Fed thinks that they need to raise unemployment in order to tame inflation. I don't know if that's actually true economically, but historically that's been the view that if you have a 3.5% unemployment rate, that inflation is going to stay high. I don't know that that holds up, entirely to scrutiny. I think you could have a strong employment market without having high inflation. I think a lot of the inflation we've seen has been driven by COVID, the policy response to COVID, and the fallout effects from that. I think it will taper off by itself, even if we don't get a significant rise in unemployment. But my guess is the labor market will loosen some, and we will see some rise in the unemployment rate by the end of the year.
All right. Thank you so much for talking with me. Pleasure having you on.
Thanks. My pleasure.
Now, the takeaway from the Fed today would be that while tight policy could remain in effect, the path ahead is less clear for actual interest rate hikes. Policymakers will have to assess incoming data and financial conditions before committing to a decision.